Okay, it's 11 o'clock here in Copenhagen, and thank you for calling into our webinar. It has almost become a tradition, I'm afraid, and I'm afraid it may not be the last webinar we have on the war in the Middle East. Today I have with me Udayan and Marios from our trading, and then I have Sean from our sister company Unicore Fuel. It is the sourcing arm of the Bunker Holding Group. And he calling in from Dubai and will give a update on the situation there and also touch upon the situation in Singapore in respect of the bunker market in general. As always, you can ask questions by using the Q&A button at the top, and then there will a curtain will appear on the right hand side, and you can put questions there. You can be anonymous, but you can also state your name. We'll take the questions at the end of the webinar. We have also received a few. You may have noticed we have put in 30 minutes this time. We realized that 20 minutes was probably a bit too optimistic. There's a lot of things going on out there. And of course, you're always welcome to reach out to us here at GRM, but also, of course, our colleagues at the various bunker holding group companies. But without further ado, let's start the presentation. I'll just share my screen. What you see here is, of course, the Brent oil price. Remember, we started at $60. We're now at around 113, 114 when I did this update this morning. We are now talking about an oil price being close to have doubled this year. And of course, most of it came after the Iran war started late end of February. This is a significant jump in oil prices, especially in oil products like gas oil and jet fuel. It is a shock to the global economy. It is often not just the level of oil prices, but it also the speed where it happens that have an impact on the economy. If we just look back at the last couple of days, this is a Bloomberg snippet I took out this morning. Maybe a bit difficult to see, but you can see how we were trading around $112 Friday night just before close. Then came out this tweet from Trump, sorry about the typo, that they were ready to scale down the military campaign. Basically, some could say was this kind of saying that it's now, oh, we can now go home. But it didn't last very long. And this morning, of course, prices are higher again, and we have closed the gap from Friday, and we are trading slightly above that. It is, of course, on the back of the 48 hours deadline that Trump gave Iran to reopen the Strait of Hormuz and threatening to start attacking the power infrastructure of Iran power plants, and that he would start with the biggest one. This is, of course, a clear escalation, and Iran replied immediately that they would also retaliate, and they would involve all energy infrastructure in the Middle East among neighbors, and it may also even include desalination plants, these that they are used to produce fresh drinking water from salt water. So a tense situation after the weekend. We also saw that Iran was able to send interballistic missiles towards this Diego Garcia, 44,000 kilometers away, the base there, a UK-US shared base. It shows that Iran is not military defeated. We have also seen the pictures from Israel that missiles have hit several cities. They have been able to make it through the Iron Dome. All focuses, of course, remains on the Strait of Hormuz. There's no news in that. Two things we, of course, keep an eye on, especially if we see new attacks on energy facilities after the deadline expires tonight, late European time, early Tuesday morning in Iran. It's the Ras Laffan, the energy facility. That's where these two so-called trains of LNG. There's in total 14 trains or LNG facilities. They took 2 of them out. That was 17% of the LNG coming out of Qatar away for 3 to 5 years. There's now talks about that these facilities may not restart before in 4 and 5 months, even if the war ends tomorrow. Of course, a lot of focus on the Ras Tanura refinery. In total, the International Energy says that 40 energy assets have been severely damaged in the Middle East. This is just underlying that this concern we had 1 week, 2 weeks ago, that this could have ramification after the war ended, that has just escalated even further. Oil production, refinery capacity will not come back to the level before the war. That will take a long time. In respect of the Strait of Hormuz, it has not been reopened. There's a very few ships going through. There's a lot of stories about friendly countries will be allowed. Even some talk about there could be some kind of customs there that you have to pay to get through, but there will certainly be no Western countries getting through. Of course, focus on Karg Island up here. Will that be sort of will the US try to take the control of that? But do notice that the Karg Island is deep into the Persian Gulf, the South Pass gas areas here. Then there's increasingly focus on the Red Sea. Saudi Arabia is up and running. They are sending maybe up to 5 million barrels. I don't think they're fully there yet to the Yanbu facility over here and the refinery over here. We see a lot of oil tankers going through the Bab al-Mandeb Strait into the Red Sea to load oil there. One of the escalation we may see is that Iran is able to activate the Houthis and close the strait again. Remember, it was closed for more than 2 years after the war in Gaza, and they have actually not been activated yet. If they are activated, we are another ladder, and we have stepped up another step on the escalation ladder. I would not be surprised to see that happening this week. It is still about products more than it is. It's of course also about crude oil, but it's very much about products. And just to recap, remember, a lot of the products from the Middle East, from the Persian Gulf, they go to Asia. This is numbers from last year, 2025, but there are also products going to Europe, to China, Africa, and even to America. If we look at the last couple of months, Europe has definitely became more dependent on the Persian Gulf in respect of products, both jet fuel, diesel, gas oil, a consequence of the tightened sanctions on products based on Russian crude that came into effect late January. So these numbers were higher in January and February, but it doesn't change the picture that Asia was most impacted both on the product side and over here to the left on the crude oil side, where both India and the rest of Asia have been significantly impacted on the product side. I think it's also important to be aware that the crisis is now spreading to other financial markets. The EIA was out saying that we should now start to work from home. We should drive at a lower speed at the highway. Here in Denmark, we had in the 70s that you were not allowed to drive your car on Sunday. I don't know if we're going back to that, but I think it's underlined the severity of the situation. Actually, Fatih Birol was out overnight saying that this conflict is more severe than the energy shocks, the energy crisis of the 70s, actually highlighting that back in the 70s, we were missing like 5 million barrels a day during both conflicts. Now we are missing 10 million barrels per day due to this conflict. Back then, remember, the oil market was smaller, so bigger impact. Energy market was more, the global economy is more sensitive to energy and oil. It's much more oil-heavy economy, but it's still a very significant impact on the global economy. And you can actually argue that maybe what we're seeing now is actually what we call, we're starting to see what we call demand destruction. Demand destruction is when the economy starts to react to higher prices. I would definitely argue we are seeing it in jet fuel, but we are also starting to see it in certain areas in Asia. Countries are introducing four-day working week. We have this story, especially in the LPG, that actually an outright lack of products. So demand destruction is starting to kick in, but it's not big enough to compensate the market for a drop of 10 million barrels of oil. And do remember, we are actually starting to see some of the demand destruction for oil is also happening at the refinery level. We saw refinery runs, for example, in Japan. It's down significantly simply due to the lack of crude oil. We're seeing some of the oil types from the Middle East that you can still get, for example, through Fujairah, are bid up significantly in price, trading at $150, $160 simply because the refineries are dependent on a specific crude oil slate. They cannot just change to WTI or whatever. If they do that, the refinery run will go down. So there's a lack, not just of crude, there's a lack of the specific crude missing from the Persian Gulf, that is a medium to heavy sour crude oil stuff. And I think it's important to understand that Asia is at the forefront of this crisis. That is also what Fatih Birol said overnight, that is the key or the center of the crisis. There are some mitigating factors being introduced also since we talked last time. We of course had the release of the global reserves, and importantly, do notice that we actually have oil products, not just crude oil, in inventories in both in Asia and Europe. It's key to understand this crisis. But in the US, you only have crude oil. The good thing is that you have heavy crude oil on inventories in the US, and that is exactly what we are missing. Nothing, very, very little new on this naval escort in the Strait of Hormuz. 6 countries in Europe said they're going to participate, but it's going to take a long time. To be honest, I don't think very many European countries are happy to participate in this escort. Trump has basically burned too many bridges, so I don't think that will give any help for the foreseeable futures. Then there's also talk about the oil on water, which you're seeing in this table. It is global crude oil on water. Notice how that jumped in the autumn when the US introduced the sanctions on sorry, I'm at home and it's my dog starting to bark because they're picking up the trash. Sorry. It rose a lot there in October, oil at sea, due to the US OFAC sanctions on Lukoil and Rosneft. But basically, all the oil has now come back into the market. There's not that much oil at sea left, only the oil in the normal transit. So the idea that this could release a lot of oil to the market. Remember also the sanction on Iranian oil at sea has been lifted, but they're not ready to let Iran get the money. It will not have an impact. It is too optimistic to believe that this will have any meaningful impact on the market. The oil and water, it is helping, but it's a drop in the ocean. I think we should expect to see a new release of the strategic reserves. We have only emptied them 20%, so that actually gives us some support to the market. Then there's something quite important that we're seeing at the moment. There's a growing competition between Asia and Europe for both crude oil products and LNG. What you have here is a so-called east-west spread. The brown one is for gas oil, and you can see how that spread normally actually traded with a negative spread, so lower prices in Asia. Now you have to pay $130 more for gas oil compared to Rotterdam in Singapore. VLSFO a spread close to $140. It came from maybe $30 to $50 before the war. High sulfur fuel oil is where we're seeing the lowest impact. So we are dragging. There's an incentive to drag products away from Europe towards Asia at the moment. So we could end up in a situation where we actually tighten the situation also in Europe because products are pushed towards Asia. We see it in LNG. There's a high incentive for LNG to go to Asia instead of Europe because the price is too low here. I think I will invite Udayan into the conversation. Udayan, how concerned are you about these elevated east-west spreads if you see it from a sort of European perspective?
Morning, Arne. Morning, all. Yeah, I think Europe's got a bit of a problem. So let's take diesel, for example, in Europe. We haven't seen, so the starting point on the diesel is the gas oil futures. We haven't seen the highest print on the gas oil futures yet that we saw in the Russian war, but we have now seen the highest print in the ULSD, the diesel contract, which trades as a diff to the gas oil futures. So the diffs in the front have blown up, and we have seen the highest print on the ULSD product. So the situation, to be honest, in some respects, is unchanged since last week. The physical situation is dire. So all eyes on when products can come out of the Middle East. We are seeing products coming from India to Europe, but as you say, the east-west spread doesn't help because then Asia is competing for the same cargoes from India, and the economics just mean that given the east-west spread, more products will go to Asia than Europe. So we have a very tight physical market in Europe, and the east-west spread is just going to make things worse unless I don't want to get into the politics of Trump's threats and all of that, but unless we see products coming out of the Middle East, we'll just see the front tightness continue. And what that means is prices in the front will keep grinding higher, and the curve further out will just go higher and higher as we go through time.
Udayan, I know what you alluded to, that said you would not go into politics, but I think the big concern is that we have seen Thailand, we have seen South Korea, we have seen China sort of introducing export restrictions. What if the US is doing this? This could be a way for Trump to get prices down in the US.
Yeah, so there was some talk of that last week. The US has come out for now and said they're not going to do it. But if you never know with these things, if things get out of hand, it's still on the cards. But to be honest, to some extent, rationally, I don't see why they would do it. But you don't know. As I said, they don't have a shortage in the US. Their refineries are running on full capacity. Unless they have a shortage in the US, it would be uneconomical for them to not export. So until we see a shortage of products in the US, I don't see that happening anytime soon, and they've come out and denied it as well. But things can change very quickly.
And here you see on the screen the so-called crack, the difference for 1 barrel of ice gas oil versus Brent, at the same for jet fuel, and especially jet fuel is of course underlines how bad this can be.
And I would like to underline something you mentioned, Arne, about the demand destruction. At some point, the economy can't sustain. You're already seeing flights being cancelled, flights being, I think a lot of airlines are stopping flights. And you'll see the same with diesel is a big component in the economy, not just in Europe, in the entire world. Once prices get to a level where the economy can't sustain it. What that level is the big question. I suspect in the front, at least, we have some more room to go. But at some point, you will see that the economy can't sustain these levels and demand will come down.
I'm afraid we're not there yet, but we're certainly getting closer, especially for some of the products. Udayan, I just included the forward curve for ice gas oil. Could also have been diesel, and there's also the jet curve. They basically look the same, even more backwardated in diesel, I would assume. If you were a consumer, how would you sort of look at the forward curve?
I would say somewhere in the middle of the curve, because the market, if you look at this curve right now, the market is still expecting a relatively quick resolution to this. So you see the front is really high up, and the longer this continues, I would say the middle months, so the 2, 3, 4 you have in there, which look relatively cheap. If this continues for a while longer, I would expect those points to be lifted up closer to the front. So I think just in the middle of that curve, if this continues, I would hedge that bit in the middle.
That's also my what I'm saying is that if you're a consumer, if you're exposed to oil or energy products, maybe this is not the time to hedge 27, 28, 29 or whatever, but it's certainly from a risk management perspective, look at the next 3 months, maybe 4 months, and don't be open there. This can get even worse than where we already are, and there are some backwardation to benefit from in the curve. And as you said, we could actually be in a situation where expectation of an extension of the war could actually start to flatten the curve. Thank you, Udayan. I think I'll leave the word to Marios, our fuel oil trader, head of trading. Marios, on the screen we see the 0.5, the 3.5% fuel oil and the cracks. Do you have a few comments for our audience?
Good morning, all. Good afternoon to you who sit in Singapore. I think that the graph says pretty much everything, but let me initially start with a small recap of what we're actually seeing in the market this morning. So it seems that the strength in the fuel market is easing a little bit. This morning we've seen the structure both in 0.5 and high sulfur fuel oil in Asia getting a touch softer. Also, gas premiums are getting a bit weaker, pointing to a softer physical market compared to where at least we were trading kind of last week or the week before. Now, if you want to take a look at the stock levels in fuel, at least for last week, Singapore was roughly unchanged. You could potentially argue that, which effectively, to me, it means that there's definitely some ARB flows arriving in the region, despite the elevated freight component. In Europe, ARA stocks rose by approximately 2%. Overall, of course, stock levels in the region are quite low. Now we're getting into the interesting part, the forward market. So at least in Europe, the forward market, and what I mean by forward, like the prompt month, like April, so it's coming in a few days' time, points towards, so the market points towards a tight April, both for high sulfur fuel oil and 0.5. And for Asia, of course, we're effectively, as you pointed out, Arne, we're seeing the biggest price impact of this conflict. We also we also maintain a bullish view. Now, the extent at which April is going to be as strong as March, either in terms of backwardation or in terms of physical premiums, is also dependent on the level at which any potential escalation of the conflict can get considerably worse. On the other hand, of course, as also Udayan and you, Arne, pointed out, at some point elevated prices are going to cause some sort of demand destruction. So effectively there, the level of the premiums or the backwardation will totally be dependent on whether this conflict is getting more severe and things are kind of getting out of hand completely, or prices go to a level and then we kind of see demand destruction hitting hard. But the key point here is that we still expect to see strength in products, in fuel products, in 0.5 and high sulfur, both in Europe and, of course, in Singapore.
Thank you, Marios. And I think it's fair to say that the gas oil strength sort of feeds into the VLSF or the 0.5 strength. That is correct, right?
Yes, absolutely. I mean,
not just this, it's across the spectrum. So gasoline, naphtha, everything's being, you cannot have one product going up and without the rest of it being dragged up. So it's kind of dragging every single product along with it, and we're seeing a similar picture across most products where we have a lot of strength in the front. Cracks are going up in the front.
Before I will leave the word to Sean, just a small comment on the gas market. What you see here is the spot, the price for the second half of the year, also the dark one, but the tiny one, and then you have 27 and calendar 27 and calendar 28. The new thing is that calendar 27, calendar 28 are starting to move higher. That is a direct consequence of the attacks on the Qatarian LNG facilities, that we will have these 17% off for maybe 3 to 5 years, and the restart of the facility is maybe delayed up to 4 or 5 months. The rest of it, even after the war has stopped. And if we see more attacks on the LNG facility, this is a true nightmare. The whole narrative about the gas market has changed. We were in a situation where we believed next winter we will have plenty of LNG in the market because of the US LNG expansion. The US will still expand, but there will be no more. There'll be less LNG from Qatar, from the Middle East. So we have a very tight market also in 27. Now it is simply the way it is. And also for this year, of course, a situation where inventories, this is Belgium, Netherlands, France, and Germany. We only have 100 terawatt hours left in those 4 countries. We're well below 2022, so we need to refill a lot of gas in Europe to be prepared for the next winter. This comes at a very unfortunate situation. So if we talk about a tight market in jet fuel, we can certainly also talk about a tight market in LNG. There are a lot of demand for LNG, and I'm afraid this could also sort of eventually mean that we will see fuel switching, especially in Asia, from gas/LNG into the fuel oil types, adding support to some of the fuel oil types like VLSFO and high sulfur fuel oil, simply because LNG is becoming increasingly expensive. Sean, a few words from Dubai.
Thanks, Arne. Yes, good day, everybody, from a very wet and rainy Dubai. I think, we're into the 4th week of this conflict, and I think many of us wouldn't have expected to have still be experiencing the local situation that we have. I think what's really important to start with is that we've touched upon on previous calls some of the numbers and statistics behind this region in terms of sailings around the Strait, in terms of cargoes that are exported out of the Gulf. Amongst everything that we're seeing, there's a lot of headlines, there's a lot of reports out there. It's important to do your fact checking as well. I think it's quite astonishing to see very prominent news outlets publishing news reports about this region that are factually incorrect, particularly when I see details on the Port of Fujairah and other areas. So knowing your sources, knowing your market, speaking to your partners is really key at this moment. I think that's even more important when we have the systems that we're used to day, particularly for tracking vessels, such as our AIS systems. They are currently jammed with all the various spoofing. That impacts us significantly in our day. It impacts the vessels that are sailing in and around the Gulf and outside. So obviously we're resorting to old school techniques and tactics in terms of sailing, in terms of communication, and in terms of day-to-day bunker deals as well. But it is a significant impact. We are very reliant on refineries in the Gulf, particularly those such as Al Zour in Kuwait. It's very important for the Middle East VLSFO market. A lot of those cargoes, which can be up to 600,000 tons per month, reach Fujairah. They then are spread out into the regional market here, but many also find their way east to Singapore. And I think if we look at Singapore, that's gone hand in hand with the significant premiums that we've seen, both on a delivered basis and cargo basis across all grade types. So that's high sulfur, VLSFO, and gasoil. In Singapore particularly, They've been finding it very difficult in terms of the premiums, same as what we've been seeing in the regional markets here. It's difficult to navigate the day-to-day, whether you're a bunker buyer, but also as a supplier, which I'll touch upon a little bit again later. But we have seen in Singapore, the demand has also come off at the end of last week. So that is helping in terms of the tightness that we're seeing. So both from the inventory side, a lot of cargoes that were on the water before this conflict started have started to reach Asia. And obviously what we're going to face moving into April is difficulty. There's not a lot of clear clarity now. If you're looking to buy cargoes as a physical, and also if you're looking to enter contracts as a bunker buyer, you're going to see a wide range of numbers in terms of the Platts relevant indexes, but you may also not see any offers at all. And that is due to the uncertainty of the cargoes that are usually coming from the Middle East to Asia. So the conflict is obviously, as we're experiencing day to day, having very, very harsh impacts to the markets. If we look here at the picture as well, you'll see the west coast of India. That's also experiencing a lot of literally dry ports, no avals. We're seeing the same in Middle East ports as well. Some suppliers don't have certain products on board barges. That also then starts to become very impactful for physicals. If you're having barges laying idle, that's a very costly impact to your business. But the demand destruction is something that Arne and the team alluded to earlier. It is already having an impact in the Middle East market. We see approximately 40% of the barges in the Fujairah Corsican market more or less idle. There is a significant decrease in demand due to the conflict, but we also see those close to 3,000 vessels that are stuck inside the Gulf that are unable to sail, finding it difficult to secure products. The high price is, of course, something else that is stemming demand. You'll look to buy the minimum just to keep either your engines running or enough to get to a port that is seeing lower prices. But it is extremely tight still in the Gulf across all product grades, VLSFO, high sulfur and gas oil. So please do make sure that if you have vessels in the area, to speak to your local partners, understand what your needs are, make it clear, because there is significant tightness both on the shore side, but also on the barges. And that is also what we're seeing in the Middle East. There is a elevated premium versus other areas, anything between $300-400 per ton premium versus some other hub ports across the three grades. If we look at the next slide, I think we also have to look, and we can clearly see from the graph as well, the sharp increase. This is the last 6 months delivered price for Fujairah VLSFO. It's very evident here the sharp impact we've had. We also see the volatility. When you look towards the last few weeks, we have seen day-to-day prices change by $100-200 a ton. We understand that can make planning very difficult for bunker buyers. That volatility is going to resume. It's going to continue all the while we have this local impact in the Middle East, particularly because it is just very unstable. We continue to have attacks on infrastructure, both in the port of Fujairah and the wider region, from Oman all the way up into the Gulf, into Iraq. So it makes it very difficult. We had suppliers at the weekend from our side, where as they're ongoing, debris are falling from intercepted drones and missiles. So you can imagine the safety impact we have. There's approximately 20,000 seafarers that are stuck in the Gulf. So we have to consider and obviously have a lot of compassion for the seafarers on board. And that is making all the operations, of course, extremely difficult to plan, and something that also needs to be considered. We are just not in a normal market anymore. There are a wide range of factors to consider. And of course, what we see today could be significantly different this evening or tomorrow, subject to the conflict and the drone attacks that we are unfortunately seeing. I'm happy to report, though, that particularly from such a hub like Fujairah, we are more or less back up and running to full speed. You have seen in the media the impacts that we had across the terminals and pipelines. We are up and running. We do see bunker barges loading. You may not see it in AIS and the systems that you use due to the spoofing and or them being turned off due to safety, but there is some loadings going on. There is product availability in Fujairah, Corfu, Khan, and down further into Oman. So they are options for vessels that are within the region still. But yeah, please do not hesitate to reach out because there is an ongoing situation. It is very fluid. It is changing hour to hour. But yeah, we are available for any further questions. Thanks, Arne.
Thank you, Sean. Let's move to the Q&A part, and remember you can go to the top of your screen, Q&A, and then there will be a curtain coming to the right hand side, and you can ask your question there. You can also do it without stating your name. I think I have a question here from Kent for you, Sean. Have you seen a reduction in stem sizes? If so, what level, what percentage? Maybe you should just explain what that means. Stem sizes.
Yeah, so a stem size would be the typical size of a bunker delivery. So on average in Fujairah, the average stem size is actually around 600 to 700 tons. In years gone by, 2014 to 18, we would have seen 2,000-3,000 tons, but that has come down significantly over the years for various reasons. We certainly see now that stem sizes are closer to 100 to 300 tons. As bunker buyers, ship owners, charterers look just to stem the minimum to get them to another port. Obviously, credit, cash flow at these higher prices with bunkers well over $1,000 a ton also starts to have an impact, and something that we are having to consider now as a bunker market.
Thank you, Sean. There's a question that we received before the webinar. Will this the situation of war ultimately mean construction of pipes infrastructure to the Middle Sea to avoid any future closure of the Strait of Hormuz? Remember the pipeline to Yanbu across Saudi Arabia was actually established after the first and the second, after the Iran-Iraq war, and yes, certainly I would expect more infrastructure projects, sort of making sure that Iran or other countries cannot interfere in exports. But the problem is, of course, this takes time. It will not solve the situation now this year and probably also next year if the issue with the Strait of Hormuz just continues. There's a follow-up questions here. I'm not sure I fully understand. What does this signal about future demand versus current supply tightness, and how would you position? I think this sort of alludes to this demand destruction thing. We are probably there. We're starting to kick in, but unfortunately, energy in general are what you call inelastic. It takes time before people react, consumers react to higher prices, because you need to drive your car, you need to drive your truck. If you have already booked your airline tickets, factories are running. You need heat in your house and so on. But we're starting to get there. How are you positioned? I cannot talk on behalf of the traders. It's confidential. But I think from my point of view, I see more. I see higher prices coming in the coming weeks, if not already this week. Of course, the ultimatum from Trump tonight will be the next key factor to watch. Then we have a question here from Thomas. How is bunker fuel availability at Asian ports? Which other ports are seeing higher demand? Sean, I don't know if you can say a few words here.
Yep. Yeah, I think if you look at Asia specifically, normally you obviously have the big hubs, ARA, Fujairah, Singapore, Houston, etc. If we just sort of divert it a little bit, the Mediterranean is certainly seeing an increase in demand. It had a tough January and February due to bad weather also that didn't help with demand, but that's certainly seeing a lot more activity in Asia, across India, Sri Lanka, towards Singapore and Malaysia. There is increased demand, but that has tapered off in the last 3 to 5 trading days. We're also seeing tightness and certain barges dry up product. So what we see is buyers looking for alternative ports, and some of these are smaller niche ports as well outside of the big hubs.
Thank you, Sean. And there's a question. LNG from Qatar could be normalized by 2027 if the war stops shortly. No, I'm afraid not, because Qatar Energy says themselves that it will take 3 to 5 years to bring these 17% back online, the 2 trains that were destroyed out of the 14. So we are probably talking 3 to 5 years. On top of that, you can of course add the supply we're already losing, and that it will take maybe 4 or 5 months actually to reopen production, maybe shorter than that. But no, it will not be normalized by 2027 in my view. Actually, I'm afraid it will take significantly longer. I think we have more or less gone through all the questions now. We're also running above time. Again, sorry about that. Thank you for calling in. We cross our fingers that we will have more calm markets ahead, but we're not sure that will be the case. Thank you for your time, and thank you for Marios, Sean, and Udayan for helping me out today. Thank you. Bye bye.